Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Welcome to another edition of Talking Real Money Daily. I'm Don McDonald, and once again, apparently you've asked all your questions. Because I don't get any calls. I have no calls. Thank goodness I still have a couple of questions coming in through the website, talkingrealmoney.com, where you can send your question in. But you can also call it in, and we'll put it on the podcast, and I'll answer the question for you, and it makes it a lot more fun. So give us a call anytime, 24 hours a day, 7 days a week, at 855-935-TALK, 855-935-8255. So today, I've got a topic I want to talk about, and I've got a question that came in, and then I'm also putting up the weekend podcast today, so there'll be lots of stuff for you to listen to. Let's get started, though. I want to talk a little about millennials today. We give millennials a hard time because they're the young ones. You know, you remember when we, the baby boom, we were young once? Yeah, it seems like such a long time ago. But now it's my kids. My kids are pretty much all millennials, I think. Yeah. Let's see, they fall in there. Yeah. Turns out that millennials may actually have the potential to be great investors. You know, we had a big bear market, almost bear market. It was down like 19-point-something%. So it was almost a bear market. And it was really the first test of investing millennials' ability to ride out the storms that happen in the stock market that will happen from time to time. And I was reading the story, where was it? Washington Post. And they quoted a 35-year-old doctor. And he said that when the market was going down, he was really worried and was closely watching his individual stock portfolio a bit too closely. Doctor. Can I call you Doc? Okay, Doc. I know you're really smart. You're a doctor, dude. You're very, very smart. But a little advice for you. You're not a stock picker, Doc. Stop picking stock. No stock. Stick to being a great doctor. Make a lot of money there. Make a lot of people really healthy. And stop picking stocks, Doc. Okay? Get a diversified portfolio of index funds. It makes it easier. Anyway, the doctor said he fought off the fear, stayed invested, and actually put even more into his individual stocks as the market declined because he had a, quote, 30-year plan. It's 35. He has a 30-year plan. Smart. The authors of the article checked with some brokerage firms to see how millennials were behaving. And at TD Ameritrade, they actually found that millennials hung in there. They were neither net buyers nor net sellers. They saved at about the same level. However, Fidelity looked through their numbers, and they found that its millennial investors actually placed twice as many stock and stock mutual fund buy orders than sell orders. So they were actually net positive investors. And there's only a tiny little dark cloud, and it'll lift with time. And that's that under 35, there's a relatively low rate of investing in stock ownership, but that's in large part because they have lots of debt. There's a lot of school debt out there. But it's at 41%. But there's plenty of time for all of you millennials to get started. And please, when you do, remember the underlying message. You are less likely to panic out of your investments if you own an academically based, not guess-based, diversified portfolio of global stocks and bonds, high-quality U.S. government bonds, based on your personal risk profile. And if you don't know your personal risk profile, Go find out at Talking Real Money for free. Just take the risk quiz there. It's a no obligation thing. It's no cost. It's really easy, and it really will help. So go check it out. And remember, give us a call, 855-935-8255, 855-935-TALK, 24 hours a day, 7 days a week with your questions. Leave the question. I'll answer it here on the podcast. Next question comes online from David. And David says, I have been listening to your podcast for over 6 months and have never heard you mention long-term care planning / insurance. What are your thoughts on long-term care products? Well, David, being the curmudgeon that I am, I think people are overinsured. The insurance companies are getting rich on our fears. Yes, you do have to think about long-term care. It is important. But there are ways to do it that don't involve buying long-term care insurance. I'll give you an example. If you're 60 years old today and you're thinking to yourself, oh, I might need to cover myself in case I'm one of the, it's about 15% of seniors who will end up in a nursing home for more than 5 years. Remember, the average of those who go in is 2. And the majority, it's not the majority that go. I mean, about half will go into a nursing home at some point, but the average is about 2 years. For many, it's much shorter. The 5-year figure is about 1 in 7 or so last I saw. So you're playing odds. That's life. Life is playing odds. So right now I did a little checking and I could find a relatively decent long-term care policy at 60 years old for a little over $2,000 a month. And that will cover me in my old age. It's about $100,000, a little over $100,000 a year that they cover. And most people, very few people last more than 5 years. It's rare. So what's your alternative? Well, what if you took that same $2,000, and let's just go with $2,000 a month at 60, and you figure you're not going to get into it going to a nursing home probably until you're like 80 or 80s. Let's say 80 and be conservative. That's 20 years away, right? You put $2,000 into a portfolio of really super safe portfolio of laddered CDs. Let's just say laddered CDs, so you can get at them when you go into long-term care and you keep rolling that ladder along, going out maybe 5 years, right? Because you're planning for a 5-year stay. So you got 5-year CDs. Average rate on that going to be somewhere in the 3% range, but I'm going to go conservative and say exactly 3%. $2,000 a month, 3% for 20 years. You do it every month for those 20 years, and you're in a nursing home. How much money is in those CDs? $660,000. $660,000. You paid the same. But why is this the case? Because insurance companies don't magically print money. They have to make a profit. They have to pay out claims. And, you could just self-insure with that same $2,000 a month, except in the most extraordinary of extraordinary circumstances. And remember, as much as you don't plan to use it and shouldn't plan to use it, if everything falls apart, you go totally broke, there is a safety net called Medicaid that will catch you. I really don't like the long-term care business, either the hybrid insurance products that are just another gimmick to get some salesman and an insurance company rich off of you. They're gimmicky. It's all gimmicky stuff. There's no magic pill that you can take that's going to save you from all the horrible things that life throws at you. You can't do it. You can't insure against everything. Heck, I probably wouldn't. I'm telling you, if I didn't have to carry it for a mortgage, I would not carry the kind of insurance coverage I carry on my house. I just would not. When was the last time a house, a relatively modern, well-built house, burned to the ground? We don't have candles anymore or natural gas piped into our lights. I'm sorry, I'm ranting again. Don't like the insurance industry very much. Just don't like it. They make a lot of money, and you don't. That's their entire system. That's really it in a nutshell. So if I had my druthers, and I do, I'm going to self-insure. And by the way, people who bought these long-term care policies years ago and thought their premiums would never go up and they'd always be covered, they were in for a rude awakening when it turned out these guys were paying out more in premiums than they thought they would. And the policy costs have gone up. They've had policies canceled. It's what happens to people is just awful. It's not like the insurance companies say, oh, hey, we made a mistake. We'll cover that, okay? It's all right. Really, it's on us. You just go to the nursing home. We'll take care of you. No, they're not in business to do that. 855-935-TALK. That's our number, 855-935-8255. And I thought since I mentioned it that I would, one of the things the concept that I'd like to cover today real quickly is this concept of laddering, because a lot of people don't get it. You can ladder bonds, but it's really easy to ladder CDs, because remember, certificates of deposit at banks, as long as you don't exceed $250,000 at any one bank, are covered. You will not lose your money. So it's very safe. The only downside is the longer the maturity, the harder it is to get the money out. You may suffer a penalty for taking it out early. That's why we ladder. So let's say you're looking at a 5-year time frame. You want your money to be absolutely safe. In case something happens, though, you want to be able to take a little bit out along the way to cover expenses over that 5-year period. So what you do is you have 6 months worth of possible need in a liquid account like a money market fund. Then you put a portion in keep a year's worth. I'm going to make this ladder easier. Keep a year's worth in your liquid account, your money market. Then you take of the money that's left, you put 20% of it into a 1-year CD, 20% into a 2-year CD, 20% into a 3-year CD, 20% into a 4, 20% into a 5. Go shop for them. You can get them at brokerage firms. You can go to bankrate.com, find the best rates. Then here's the trick. The minute the 1-year CD comes due, you immediately don't say, well, I think interest rates might go up a little bit. No, do not do that. Do not do that. Immediately roll it into the best interest-bearing 5-year CD you can find, and just keep doing that. Simple. All right, then. That's it for this one. I'm going to go put these 2 podcasts up online, and, of course, encourage you to call with your questions at 855-935-TALK. The other thing I'd like to encourage you to do is go to talkingrealmoney.com, because there's fun stuff to do there. Some people have written in saying, well, how do I check on my broker? Well, we've got a link to go to the SEC Advisor Check website. I don't know if we have a link for Broker Check, the FINRA one, but it's Broker Check. Look that up. We also have a lot of other links to cool things that you might need, including our risk quiz, which is free, no obligation. And something we just started a month or so ago is advisor appointments that you can just make online anywhere in the country, and we'll meet with you either by phone or video. You don't need to be in the Seattle area, and we'll help you out with your money stuff with no cost or obligation. Now, we will not become your advisor for life for free. That would just be a bad business model. But we will help you out, because the firm I work for, Vestory, Tom and I founded it, and we founded it based on educating everybody, because we knew that if we educated everybody, even people who didn't become clients, that it's very likely, and we found this is actually the case, it works, that the people we help go to their friends and they say, yeah, they really helped me out, and they weren't pushy, and they weren't obnoxious, and they didn't try to sell me anything, and you really, because you have friends, they need help, right? You really need help, and these guys are very good. They will help you, because we're pretty good at what we do. So go check it out, talkingrealmoney.com. All of those things are right there in a non-threatening environment without any sales pressure stuff. All right? Tell a friend about the podcast. Subscribe, particularly through Apple Podcasts or iTunes. And, oh, please, Tom and I would both appreciate it if you take a second and go to Apple Podcasts or iTunes and click on the stars. At least that. I mean, if you're feeling thoughtful, write a little quick review, but at least click on the stars. Thanks so much. Thanks for listening to Talking Real Money. I am Don McDonald.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?